Welcome to Breaking News to Trading Moves.
Today, we are looking at a single piece of financial reporting that really gives us a map of the entire logistics world right now.
Absolutely. We're talking about the recent fiscal Q2 results from FedEx, FDX. We're going to use this report to figure out who might be facing some headwinds and, who's catching a tailwind across logistics, transport, and e-commerce.
Right. We're not just looking at the numbers themselves, we're trying to see what those numbers tell us about the market. Who are the immediate beneficiaries, and who might be feeling a bit of pressure because of what FedEx is doing? We want to give you the context behind the headline.
Okay, let's start with that headline. Section 1, the core event, which is FedEx's Q2 results and a bit of a warning that came with them. On the surface, the initial news looked really good.
It did. FedEx beat expectations for its fiscal second quarter, which ended back on November 30th.
A strong beat. And they didn't just have a good quarter, they actually increased their profit forecast for the full year, right? At least the lower end of it.
They did, which in this kind of choppy economy is a really positive signal. When a big bellwether like FedEx says things are looking a little better, investors tend to listen.
So we know they beat. The big question is always why. What did they do to make that happen? It wasn't just about moving more boxes, was it?
No, far from it. This was a really strategic beat, and it was built on three main things. The first, and maybe the most important, was getting higher package yields in their express division.
Okay, let's break down yield for everyone. It's basically revenue per package, but why is that so critical right now?
Well, it's about quality over quantity. You can move 1 million cheap, low-margin packages, or you can move fewer high-value, high-margin ones. When FedEx talks about improving yield, it means they're getting paid more for premium services.
So they're being more selective.
Exactly. They're focusing on profitable freight, things that are time-sensitive or specialized. Shows they have pricing power, even when the broader market feels a bit soft. They're not just chasing every package anymore, they're chasing the right packages.
Okay, so that's the first driver, getting better quality revenue. What was the second piece of the puzzle that helped them beat?
The second big one was just good old-fashioned cost-cutting. But not in a temporary way. We're talking about effective, ongoing cost actions across the whole company.
This is more than just, cutting back on office supplies.
Oh, much more. This is deep structural stuff. Optimizing their routes, streamlining their networks, merging air and ground operations where it makes sense. The goal is to permanently lower their cost to move a package.
So all those investments in technology and network upgrades are actually starting to pay off.
That's it. When you're as big as FedEx, even a tiny improvement in efficiency, like a fraction of a percent, translates into hundreds of millions of dollars in savings. And that flows right to the bottom line. It's probably the most sustainable part of their good quarter.
And what about the third driver? You said it ties back to that yield strategy.
It does. They mention specific success in a few targeted sectors.
Which ones?
Healthcare and automotive. And that's very telling. Healthcare shipments are high-value pharma, medical devices, things that need careful handling.
And automotive is all about just-in-time delivery for parts, which is a premium service.
Exactly. These aren't just high-yield shipments. They're also stable. So even if general e-commerce is a bit up and down, these sectors provide a solid, profitable base. It proves their strategy of going after high-margin clients is working.
Okay, so a solid quarter based on better prices and tighter cost control. But this is where the story gets a little more complicated. They raised their guidance, but they also flagged a warning about some future costs.
Right. There was a definite note of caution that came along with the good news.
What was the specific issue they pointed to?
It all comes down to unexpected costs during the peak season, tied to the grounding of some of their MD-11 cargo planes.
The MD-11s. Those are the big trijets, the workhorses of their long-haul fleet. Grounding planes, especially during peak season, sounds bad.
It's a major headache. It means an unplanned loss of capacity. These are older planes, so it could be maintenance, safety checks, something that just couldn't be put off any longer. But whatever the reason, when you suddenly lose big cargo jets from your network, you have a serious capacity gap you have to fill immediately.
And I imagine filling that gap is not cheap. Did they put a number on it?
They did. They estimated the total cost would be about $175 million.
Wow. Okay. That is a big number.
It is. That's the cost of finding replacement planes on the charter market, which is always expensive, rerouting freight, paying overtime. It's a huge operational expense.
$175 million. That's a real dose of reality.
Yeah.
And when is that cost going to show up in their financials?
It's expected to weigh on the current quarter, their fiscal Q3,
Right.
which ends February 28, 2026. And this is the key point for anyone watching the sector. This operational problem for FedEx, this sudden loss of air capacity.
It has to affect other companies.
It absolutely does. The demand doesn't just go away. That freight has to move somehow, and if it can't go by air, it gets pushed into other modes of transport. This problem for FedEx immediately becomes an advantage for ground carriers.
That sets the stage perfectly. So let's move into section 2 and talk about who actually benefits from this whole situation. The winners.
Let's do it. And we can start with a group we're calling the pricing power group. This is integrated logistics and contract logistics. And the first names on the list are, maybe surprisingly, FedEx, FDX itself, and GXO Logistics, GXO.
Okay, I have to stop you there. We just talked about FedEx facing a $175 million problem. How are they also on the winners list?
It's because the market looked past that temporary operational issue and saw that their core strategy is working, the whole pricing plus productivity approach. They proved that even with a hiccup, their plan to focus on quality revenue and aggressive cost control is the right one.
So the market is basically saying, okay, the MD-11 issue is a short-term pain, but the long-term health of the company looks stronger because the strategy is sound.
Precisely. And that validation helps the whole group. Look at a company like GXO Logistics. GXO, their entire business is built on that same idea. Productivity and pricing. They help big companies streamline their supply chains.
So FedEx's success proves that shippers are willing to pay for these premium, high-value logistics services.
Yes. It confirms that the market values reliable execution. GXO specializes in things like warehouse automation, robotics, sophisticated software to manage inventory.
Right, they sell efficiency.
They sell efficiency and cost control. When GXO signs a contract, they're promising to make their client's supply chain cheaper and more effective to run. FedEx's report just reinforces that companies are willing to pay for that kind of value rather than just chasing the lowest possible price.
That makes sense. The whole industry gets a boost from that validation. Okay, so let's move to the next group, the ones who benefit directly from that MD-11 grounding. We're calling them the overflow group.
Right. This is ground transport and intermodal. And the connection here is really direct.
Air freight is fast and expensive. When a huge player like FedEx loses that capacity, the freight has to go somewhere else.
It has to. And if it's urgent, it needs the next fastest thing, which is usually an expedited truck or maybe the rail system. So we're looking at companies like J.B. Hunt Transport, that's JBHT, and Knight Swift Transportation, KNX.
Okay, J.B. Hunt, JBHT, is a huge name in intermodal, using both trucks and trains. How does an air capacity problem help them specifically?
Intermodal is the perfect middle ground. It's not as fast or as expensive as air, but it's faster and more reliable over long distances than just a single truck. So if a shipper suddenly can't get their stuff on a plane...
They look to J.B. Hunt to move it across the country on a train.
Exactly. It's volume that JBHT might not have won otherwise. It's an unexpected little boost for them.
And I assume the same logic applies to a company like Knight Swift, KNX.
It does. They have a massive trucking fleet, including expedited ground services. When air capacity gets tight, demand for those fast ground services spikes. It's simple supply and demand. Less supply in the air means more demand on the ground.
Which gives ground carriers like KNX more pricing power.
It can, yeah. They capture that overflow demand, and they might be able to charge a little more for it because the system is constrained. One company's problem becomes their tailwind.
It's fascinating how one issue can create these openings. Let's talk about the last group of beneficiaries. Supply chain and logistics software. The efficiency tool group.
This group benefits from FedEx's overall strategy. Remember all that talk about structural cost reduction? Well, these are the companies that sell the tools that make it possible. We're talking about Manhattan Associates, MANH, and Descartes Systems Group, DSGX.
So when carriers are obsessed with cutting costs, the software that enables it becomes essential. It's not a luxury anymore.
Not at all. You can't save hundreds of millions of dollars just by telling people to work harder. You need technology to redesign your processes from the ground up.
So what exactly are companies like Manhattan Associates, MANH, selling?
MANH is a leader in warehouse management systems, or WMS. Their software tells a warehouse the most efficient way to store inventory, the fastest path for a worker or a robot to go pick an item. It optimizes every square foot of space.
So when FedEx or GXO want to lower their warehouse costs, they're buying software from a company like MANH.
That's the idea. And Descartes, DSGX, they're a big player in transportation management systems, or TMS. That's all about route optimization.
Making sure trucks are always full and taking the most fuel-efficient path.
Right. It's all about lowering the cost per shipment. Their software also provides visibility, so you know exactly where a package is at any given moment. which cuts down on expensive customer service calls and delays.
So really, these software companies are selling the tools the big logistics players need to hit their own productivity goals.
That's a great way to put it. They're essential enablers. Every dollar FedEx saves using better routing is a win for the company that sold them the software.
Okay, that gives us a really clear picture of who's benefiting. But let's flip this around now for Section 3 and look at the groups that are feeling the pressure. Where do we start?
We can start with the LTL freight carriers. We're calling them the softness signal group.
LTL, so that's less than truckload. We're talking about freight that's bigger than a parcel, but not big enough to fill a whole truck.
Exactly. It's a really good barometer for the industrial and manufacturing economy. And the warning sign for this group actually came from inside FedEx's own report. They noted that performance in their FedEx Freight division was weaker.
So while their high-yield express business was doing great, the LTL side was soft.
Right. And that suggests that the broader industrial economy might be slowing down. The stuff that moves LTL is machine parts, components, goods for retail stores. If FedEx is seeing less of that, it's a signal that manufacturing output might be cooling off.
And that creates pressure for the big pure-play LTL companies like Old Dominion Freight Line, ODFL, and SAIA.
It does. This is where market perception really matters. The LTL sector is known for being cyclical. So when a bellwether like FedEx reports soft LTL numbers, investors get nervous about the whole group.
So even if a company like Old Dominion is running a great operation, the bad news from a competitor can still drag them down.
It can. The narrative becomes about overall sector demand, and that can overshadow how well an individual company is executing. It's just a cautionary signal from the FedEx report about the near-term health of manufacturing.
Okay, that makes sense. Now let's talk about direct competition. The next group facing pressure is parcel delivery rivals and network operators. The competitive group, we're talking about UPS and Amazon.
That's right. FedEx's strong quarter really raises the bar for everyone else in the small parcel space. When FedEx proves they can drive margins up through cost control and higher yields, the market immediately asks, well, why can't UPS do the same thing?
So the pressure is on UPS, that's UPS, to match that performance.
It is. And that intensifies the competition for the most profitable shipments, the healthcare and high-end commercial business. FedEx just showed they can win that business profitably.
And if you're UPS or Amazon, AMZN, how do you respond to that?
You're kind of stuck between a rock and a hard place. You might have to accept lower profits on some contracts just to keep a customer from switching to FedEx. That creates pricing tension. Or you have to spend a ton of money on capital expenditures, CapEx, to upgrade your own network to match FedEx's efficiency.
So you either hurt your margins now by cutting prices, or you hurt them by spending a lot of money to catch up.
Either way, you're feeling the squeeze. And for Amazon, AMZN, it's a double pressure. They're a huge shipper, but they're also trying to build their own delivery network.
Yeah, they have to compete with FedEx's efficiency.
Exactly. The FedEx report shows just how lean and mean Amazon's own logistics network has to be to compete. If FedEx is getting more efficient, Amazon has to work even harder to lower its own internal delivery costs. The bar just got higher for everyone.
No doubt. Okay, that brings us to our final group, feeling the pressure. And it might be the most relatable one for our listeners, the customers themselves.
Right. The margin pressure group. We're talking about shipping cost-sensitive e-commerce and direct-to-consumer companies.
Yeah.
Think Wayfair, W, or Chewy, CHWY.
This is the other side of the coin, isn't it? If FedEx is succeeding at getting higher yields.
It means their customers are paying higher prices, their pricing actions are working, surcharges are sticking, and for an e-commerce company with really thin margins, that's a direct hit to their bottom line.
Let's use Wayfair, W, as an example. They sell furniture. Why is this especially painful for them?
Because they ship big, bulky, awkward stuff. A couch, a mattress. These things are expensive to ship to begin with. They get hit with dimensional weight charges, where the carrier charges you for the space the box takes up, not just its actual weight.
So when FedEx raises its rates and surcharges, the increase for Wayfair is massive because their starting cost is already so high.
Precisely. Wayfair can't easily absorb those costs without their profits just evaporating. It's a huge challenge for their business model.
And what about Chewy, CHWY? They sell pet supplies.
Their challenge is a bit different. They ship a lot of heavy stuff, 40-pound bags of dog food, cat litter. That's dense and costly to move. Plus, they have a subscription model, so they're shipping this stuff over and over.
And they have to manage returns, too.
Right. And returning a big bag of dog food is expensive. They essentially pay for shipping twice on that one item. For a company like Chewy, CHWY, Logistics cost is everything. When carriers raise prices, it's a direct headwind for them unless they can pass that cost on to their customers.
So these e-commerce companies are the ones funding the carriers' push for better profits.
In a way, yes. They feel the squeeze most directly. It's a real challenge when their customers have been trained to expect fast and free shipping.
This has been a really thorough look at how one report can tell us so much about an entire industry. Let's try to sum it up for everyone. FedEx's focus on costs and pricing is working, and that's good for integrated logistics players like FDX and GXO.
And their airplane problem, the MD-11 grounding, created a surprise opportunity for ground carriers like JB Hunt, JBHT, and Knight-Swift KNX.
But on the flip side, the report sent a warning signal about the LTL sector, which affects ODFL and SAIA.
And it definitely raised the competitive bar for rivals like UPS and Amazon AMZN, while putting real margin pressure on e-commerce companies like Wayfair W and Chewy CHWI.
So it all comes down to this. Carriers are successfully getting paid more to move stuff.
Which leaves us with the big question that will probably define the next year in e-commerce. Can these businesses actually pass those higher shipping costs on to consumers without scaring them away or hurting their sales volumes?
That's the billion-dollar question. And just a reminder, this discussion is purely the opinion of the author. It should not be taken as financial advice or a recommendation to buy or sell any security. We strongly encourage you to do your own research.